All right, so yes, we are learning about long-term assets. You all were right. And we've learned that those long-term assets can be classified in different categories, right? So we've learned about some of those. So, for example, there are tangible and intangible long-term assets. And by intangible, what do we mean?
Idea.
An idea. That's true. Yeah. Exactly. So it's when we have some sort of idea and then we take some legal steps to protect it by patenting the product, copywriting the song, or whatever it might be. So those are intangible. Other tangible products, assets, would include things like property, plant, and equipment, right? That would be things like real estate. It would be a factory. It would be equipment, obviously. Even land falls into that category. What other types of long-term assets are there besides PP&E and intangible? You could have long-term investments. Those would also be long-term assets. We could also have natural resources, which get depleted instead of depreciated. We looked at how on the balance sheet you break down these assets into different categories. So obviously, current assets would be anything that you are likely to use or could use within a year, right? Including supplies, inventory, accounts receivable, all of that falls under current assets. And then in the long-term assets, again, we've got investments like securities, that would be stocks and bonds, PP&E, goodwill, which was mentioned earlier. I don't think we talked about goodwill yet, right? So we'll get to that. Intangible assets and other. All right. So a lot of these we can just kind of skip past here. This was an important concept. Repair and maintenance costs are sometimes an expense. Sometimes they actually get capitalized, meaning they get spread out across multiple years. What makes the difference with a repair? When would it be expensed versus when would it be capitalized?
Capitalized would be an upgrade.
Okay.
And this is potential oil tires.
Exactly. So if it's fairly routine, changing oil, something like that, it's just an expense. You can go ahead and take that expense now and reduce your tax liability. If it is somehow enhancing the product, so it's not really a repair, it's more like an upgrade. God bless you. So you're extending the life, extending the capacity, extending the value of that asset. In any of those cases, well, then you're increasing the value. Obviously, you capitalize that cost over a number of years. All right. We did some practice. Oh, there's a typo. Never caught that. It's supposed to be trial balance. It says trail balance. Oops. Okay. We did talk about this. On this trial balance, we see, well, actually, these are all assets. Normally, trial balance would have all the accounts. This one is only showing us the assets. And we have the current assets first. Then we've got our long-term assets. Then notice we've got accumulated depreciation on our equipment. So, as I'm sure you remember, we have to record how much depreciation there is. We do that in a separate account. That type of account is a contra asset account. So that's the only asset type of account where when it increases, you credit instead of debiting. And what's the whole point? Why, if we have equipment worth 45,000, or at least that's what we paid for it, why do we have a separate account for accumulated depreciation on the equipment with a credit of 5,000? Well, wear and tear is what causes things to go down in value over time, although really the value could go up, right? But in theory, there is wear and tear. And that's the basis behind the whole concept of depreciation. But why do we record it in a separate account instead of just reducing the cost of the equipment? You remember that there was the cost concept in accounting? That's one of the principles that GAAP says we have to follow. You have to list assets at the cost you acquired them for. And then any depreciation or depletion for natural resources, you have to record separately. So then if you want to figure out the value of that asset on your books, not the market value, just the value on your books, you would say, okay, well, we originally spent 45,000 on the equipment and we've taken $5,000 of depreciation. So we have a book value of $40,000 for that equipment. And why do we care about that? Why do we need to know the book value?
You can calculate depreciation.
Well, I know you just came in. So, well, this is assuming we know the depreciation and the depreciation gave us the book value, but why do we need the book value? When does that become important?
Salvage price.
Yeah. Yeah, when we sell it, right, in the future, which is what your salvage value is an estimate of, we want to ideally sell it at an amount that is at our book value, so that we don't have to pay any taxes on that sale. We sell it for more than the book value, it's a gain. We sell it for less than the book value, it's a loss, right? All right. Any questions, any comments? All right, so with physical assets, we typically are going to depreciate, assuming they're long-term assets. We're going to depreciate the cost over a period of time. And we've got three basic methods to do that. You see them here: straight line, units of production, and double declining balance. Depletion, I almost said it again. I almost said depreciation. Depletion we use for what type of long-term asset?
Natural resources.
Natural resources. And amortization we use for what type of long-term asset? Intangibles. Very good. That's right. Okay. As a reminder, the acquisition cost of an asset includes shipping, it includes any sales tax we had to pay, it includes any costs associated with getting that asset up and running. All of that becomes the acquisition cost. It does not include any ongoing maintenance, insurance, anything that's kind of after the fact is separate. But the costs associated with acquisition are the amount that we then capitalize. All right, so that's just a journal entry. Okay, in calculating the depreciation amount, so if we're doing straight line, what we're going to do is take the cost of the asset, subtract the salvage value, which is how much we expect to sell it for in the future. That gives us our depreciable base, right? We divide that by the number of years we're planning to use the asset, and that gives us our annual depreciation. Once we've calculated that annual depreciation at the end of the year, this is how we would journalize it. It's just a debit to depreciation expense. It's a credit to accumulated depreciation. The contra asset account we already talked about. And then again, to figure out the book value, you take the original cost, also known as the historical cost for the asset, minus the accumulated depreciation, and you get your book value. So here's an example. We spent $54,000 on the asset, plus shipping, plus setup. Here's our total cost, minus the salvage value, right? Because we don't want to depreciate that salvage value. And that gives us our depreciable base. Take that depreciable base of $48,000, divide it by the number of years, and we get our annual depreciation expense. Straight lines, fairly straightforward. Questions, comments regarding straight line depreciation? All right, so then, oh yeah, this showed us that if in the first year we have $9,600 of accumulated depreciation, that was how much depreciation we took in year one, then we just subtract that from the original cost, we get the book value, right? And then in the second year, now we've got 2 years worth of depreciation that have accumulated, right? So we would take the original cost minus all of the accumulated depreciation to get the new book value. So every year, the accumulated depreciation keeps going up and the book value keeps going down. Until what point? At what point you stop depreciating the asset?
Just worth nothing.
Yeah, you keep depreciating until the book value is 0, or if you are planning to resell it until you get down to the salvage value. Okay, if you use the units of production method, it starts out the same. Take the original cost, subtract the salvage value, but then you divide by how many units of production you're expecting for that asset. Right, in this case, it's how many pages can be printed. We saw another example, how many miles the truck could be driven. So whatever the production is of this unit, of this asset, excuse me, estimate the lifetime of that asset and how much it's going to produce. In this case, 960,000 pages. That's what you divide into the depreciable base to get your depreciation expense per unit. Now for every page we print, that's 5 cents worth of depreciation cost. So at the end of the year, we just take the number of pages we printed, multiply by 5 cents. That's our annual depreciation expense. And in doing it this way, you're going to have more depreciation expense in your busier years when you probably need more of the tax write-off and less in the years where you're slower. Then we have the double declining method, right? This one gets a little tricky. You take the original cost, don't subtract the salvage value, just take the original cost, multiply by 2, divide by the number of years you're expecting to use the asset. That's how much depreciation you take for the first year. Then for the second year, you're going to take whatever's the book value at that point. Right, so the original cost minus the first year's depreciation, that's your book value. And you multiply that by 2, divided by the original number of years. And you keep going until you get to the point where you're pretty close to the salvage value. And then your depreciation expense just becomes whatever gets you from your book value down to your salvage value. So usually in the last year or the next to the last year, you don't even have to do any division or multiplication, you just subtract. Right, so like that's what we see here. So they had a pretty big depreciation expense in the first year, smaller in the second year, smaller in the third year. Now it got to the point where they're just a little bit above the salvage value. So then you just depreciate the difference. So they depreciate $2,528, gets them down to the $10,000 salvage value, and then there's zero depreciation in this case in the final year. And why might you use this double declining method instead of straight line or units of production?
A bigger tax write-off.
Bigger tax write-off in the first couple of years. That's exactly right. So if that's what you're looking for, then this might be the way to go. And yeah, if you're spending tens of thousands or hundreds of thousands of dollars on an asset, maybe you do want that bigger write-off to save yourself some taxes right off the bat. All right, any questions out there? Oh, I don't think we got this far. Let me check my notes. That was as far as we got. Okay. Okay. So imagine you work for this company. You're reviewing the financial statement. Oh, no, you don't work for the company. You're reviewing the financial statements of this company. Okay. And there is an asset called USB. Now that's one of those little thumb drives, right? That you can store data on. And it says it's worth $10,000. That's a pretty valuable USB drive, right? Okay. It has the code for a game that the company developed. They think the game's going to be pretty popular, and they've depreciated it over 5 years using the double declining method. Does this seem like the appropriate way to handle this asset? Is there anything weird that sticks out to you in the scenario? Is it really the USB that's worth $10,000? What's worth $10,000?
Code.
The code, right? The code is intangible. The USB drive is tangible. So we shouldn't actually depreciate it. What should we do if we want to record the value of that code in our accounting records?
Patent, trademark it.
Yeah, we would copyright it. We copyright the code. And we could say the code is worth $10,000. Can we use the double declining method then to capitalize the cost of that code? No, because intangible assets we have to amortize. Right? And double declining, that's a method of depreciation. We can only use that for physical assets. If we really had a USB drive that was worth $10,000, yeah, that's a physical asset. We could take depreciation. We could use the double declining method. But why would anybody pay $10,000 for a USB drive, right? It's the contents that might be valuable. You can get a USB drive for much less than that.
First of all, why would it be that it's picked up in the first place?
Good question. Yeah, it's not very secure, right? Somebody could drop it down the gutter or
So or trash by accident.
exactly. So probably somebody wasn't thinking very straight. All right, here we've got somebody thinking of buying a new silk screening machine. Silk screening is like if you want to print on a t-shirt. It's usually done with the silk screening machine. And he expects sales to increase over the next 5 years. Okay, so he's expecting his revenue to go up over 5 years. And then he thinks he's going to need a second silk screening machine 2 years from now. Which depreciation method should he use for his silk screening machine? Should he use straight line, units of production, or the double declining method? He could use any of the three, right? But from an accounting standpoint, would there be an advantage to using straight line? One advantage would be simplicity. You know exactly what your depreciation expense is going to be for 5 years. I can't really think of much else. How about units of production? What would be a benefit if he uses the units of production method?
The more sales he has, more expenses.
Okay, since he's expecting sales to go up, as sales go up, he's got more of a tax write-off. And since he has only one machine now, that machine's going to be doing a lot of production. Once he gets a second machine, then maybe he's not using the first machine as much. But then he'll be taking depreciation on both machines together. So yeah, as Julian said, it might be useful in the sense that it gives him more of a tax break as his business picks up and he gets busier. What about the double declining method? What benefit would there be if you use that? As was said earlier, bigger tax break up front, right? And since he's going to buy a second machine in 2 years, that might make a lot of sense. He gets a big tax break on the first machine in years 1 and 2. By year 3, he's now buying his other machine. And then he can figure out what depreciation method he wants on that one. So there are options, right? It all depends on what he's trying to achieve. You're trying to maximize your tax breaks? Great. But maybe he doesn't want to do that. Maybe he doesn't care so much about paying income taxes, and he'd rather make his company look more profitable. In that case, the units of production or straight line would be better than the double declining method. So there's no right answer here. He's got basically 3 options. Any of them could be fine, right? Depending on depending on his preference. Okay, so now he buys a silk screen machine for $10,000. He's planning to use it for 5 years or 100,000 presses. The salvage value is $1,000. What would be the depreciation cost for the first 2 years using all 3 methods? So let's put our knowledge to the test here. Take some time, feel free to work together. Figure out year 1 and year 2 depreciation in all 3 depreciation methods. Any questions? Okay, I'll give you 5 minutes or so to work on that. All right, look at my calculator here. The $10,000 minus 1,000 for the salvage value. And then divide by, how many years was it? 5 years?
Yeah.
Okay, so Jack is exactly right. And how about for year 2?
Good.
It's the same. Yeah, just checking. Yeah. It's the same. All right, with straight line, it's the same amount every year. Very good. All right, what about units of production? For years 1 and 2.
1,800 for the first year. 7 for the second.
Okay. So again, we had the $10,000 original cost minus the $1,000 salvage value, 9,000. And then what do we do from that point?
Divided by 100,000.
Divide by the 100,000 presses that are expected. That means each press has a 9-cent depreciation expense. And then the first year has 20,000 clothing items, so that's 20,000 presses. Lewis is right, 1,800 for year one, and then what did you say for year two? 2,700, okay. We have 30,000 pieces of clothing in year two. That's exactly right. All right, and then how about double declining? What's our year one depreciation expense? 4,000? That sounds right. So it's $10,000, right? We don't do anything with the salvage value at this point. Times 2, or double, divided by 5, because that's how many years we're planning to use it. And yep, it is 4,000. So what is our book value after we take $4,000 of depreciation? $10,000 cost minus $4,000 of depreciation. Our book value is now 6,000, right? And so we repeat that process in year two. We take 6,000 times 2 divided by 5. Our depreciation in year two is going to be 24. Okay, it's a good job. Not really that hard, right? Any questions about those calculations? All right, well, let's see what's next. Intangibles, okay. So we did, I think, cover this a little bit in the exercise set. So we kind of got a preview. With intangibles, as you know, they're amortized, not depreciated. And it's very similar to your straight line depreciation. It's actually even easier because you don't even have to deal with the salvage value. You just take the cost of that intangible asset, spread it over how many years you expect to use it. That's it. As it says here, internally generated intangibles are expensed as the costs are incurred. As we learned about earlier, the research and development that goes into developing a product under GAAP is taken as an expense. Because we really don't know what the value of that product is going to be, right? So whatever costs go into developing it, we just take as an expense. If, on the other hand, we buy somebody else's patent or trademark or copyright, well, then we know what the cost is, right? And then we amortize. There's an exception, though. The legal costs with registering or defending would be capitalized and amortized. So if you go to patent a product, maybe you already spent $1 million developing that product, but you would have been taking those expenses all along. Now that you've got your product and you want to patent it, let's say it costs you $5,000 to get the patent. That cost you capitalize. So there are some intangible assets that we don't capitalize. You'll see when we get to goodwill, that would be an example. We do not even capitalize goodwill. So here's an example. This company bought a copyright for $10,000 for a graphic novel. They're planning to use it for 10 years. We just take the cost, divide by the number of years. That is your annual amortization expense. And then again, there's no accumulated amortization. You just reduce the value of that intangible asset every year. So the copyright loses $1,000 of book value every year. So here's another one. They bought a patent that cost $20,000. They're planning to use that for 20 years. Again, comes out to $1,000 a year. debit to amortization expense, credit to patent. So after 20 years, what would be the book value on that patent? 0, right? It would have been completely amortized. Then we get to goodwill. So goodwill is when you buy a company, you pay more for that company than it is worth on paper. So in this case, the company bought another company, actually some sort of sports team, a basketball team. The company bought a basketball team for $10 million, but that basketball team only had $7 million of assets. So on paper, it's not worth 10 million, it's only worth 7 million. The difference, the amount that the company paid more than the value of their acquisition, that is goodwill. So when you buy another organization, the amount you pay above their net assets, their book value, is goodwill. And then you never increase that goodwill. If you decide that you overpaid and you didn't really have as much goodwill, as much extra value as you thought, you can decrease goodwill, but you never increase it. Because how would you prove to anybody that, oh, this basketball team's really worth more than I thought it was when I bought it? You know, that would be a hard thing to substantiate. So that's all there really is to goodwill. Anyone have questions? Here's an example where you've decided that you really didn't get as much value out of that purchase as you thought. Like you buy that basketball team and then you see them play and you're like, oh man, what did I do? I think they're worth $1 million less than the 10 million I paid for them. So I'm going to go ahead and reduce the goodwill and debit impairment loss. The only time we see that account name in the whole course. Okay, so then we have a problem. I'm curious what comes after the problem. Okay, a few things. Okay, so let's go ahead and get this problem done. Problem number 9. Oh. Okay, so we're calculating the annual amortization expense. You know, this one's so easy. We'll just go through this together. Okay, part A. There's a patent with a 10-year legal life. So we can keep using this patent for 10 years. If anybody makes our product without our permission, we can sue them. However, we're only planning to use it for 8 years. It's the useful life that we use for figuring out the amortization, not the legal life. We use the useful life. So it says calculate the annual amortization expense and prepare a journal entry. How would we figure out the annual amortization expense for A? What was that formula for calculating your amortization expense? Yeah, it's basically straight line. You just take the cost of the patent and we divide it by the number of years we're planning to use the asset. So let's see, this is chapter 11, problem 9, right? Oh, I already had it open. Right. So we take the $300,000 cost, divide it by the 8 years we're planning to use it, and that's our annual amortization amount. $37,500. And our journal entry is just a debit to amortization expense credit, what's too many zeros? Credit to capital. How about for B? What would be our annual amortization amount? Cost is $24,000. Market value is $600,000. I don't know why we got such a good deal. If it's worth 600 grand and we're only having to pay 24,000. But the market value doesn't matter. It's the cost that we actually paid, that is what matters. So we take the 24,000, and then would we divide it by, well, actually it's the same. The useful life and the legal life are both the same. But if they were different, we would use the useful life. How many years we're planning to use the asset. So we take $24,000, the cost, divide by the number of years we're planning to use it, 20. I think that comes out to 1,200.
Yes.
Okay, so that's our answer. We have a $1,200 amortization expense. And we credit patent $1,200. All right, any questions on amortization? So what happens if you start depreciating an asset and then something changes? Maybe the number of years you're expecting to use it changes. Maybe the salvage value changes. What do? Well, that's no problem. Whatever amount you've already depreciated is fine. You don't have to go back and change anything. You just recalculate your depreciation for the rest of the life of the asset. And that's what we see here. So this asset, let me zoom in a little bit so you can see it better. And this asset had a $58,000 cost. And it originally had a $10,000 salvage value. And then we're doing straight line depreciation. So take 58,000 minus 10,000, that gets you 48,000. And then divide by, I think they're doing 5 years, which comes out to a $9,600 annual depreciation expense. So that's what they're doing, just straight line, $9,600 a year. 3 years go by. So 3 times their annual depreciation of $9,600 is a total $28,800 that they've taken in depreciation so far, giving them a remaining or a book value of $29,200. But then something changes. And they decide that they now think that when they sell the vehicle, it's going to be worth 6 years, and they're going to sell it 5 years from now. Like I said, no problem. We've already taken all this depreciation up here. So what we do is we start with our current book value, subtract our new salvage value to get a new depreciable base. Divide that by the 5 years we're still expecting to use the asset, and we get a new depreciation amount. Okay? It's kind of like you just do it all over. You just start with whatever book value you have, and just recalculate. God bless you. And we will get to practice that in the, did we do one like that in the exercise set? We do one? No, if not, we have one in the problem set. I think it's probably in the problem set. All right. Okay, so here's a brain teaser for you. It's not too hard, really. So there were trucks that had a useful life of 7 years. That's not a very long useful life for a truck, right? But I guess the company's planning to sell them in 7 years. They take 2 years of depreciation. Okay, so started as a 7-year useful life, 2 years have gone by. So how many years are remaining at this point? 5. Then they make some improvements to the trucks that extend the value by 2 more years. And now what's the useful life? But we just extended it, right?
So 7.
So now 7. Right, so we started with 7 years, 2 years go by, but then we extend the life of the trucks, so we're still at 7 years. Okay, and then I keep telling you that the reason we care about book value, well, not only because it shows up on our financial statements, that would be one reason, but also because if you sell an asset, you need to know if you have a gain or a loss, right? So let's take a look at the situation here. There was a printing press. There had been some depreciation that had been taken, so the book value of the asset was this, $29,200. If we sell it for anything more than that, like $31,000, for example, the difference is a gain. It gets reported on the income statement, and it increases our tax liability. It also increases our profits, right? Gains increase our profits. So it's got a good side and a bad side. This is what the journal entry would look like when we sold that asset. So we got rid of the printing press. And assets increase on the debit side, right? And now that we've sold it, we have to take it off of our books. So we have to credit it. We don't have it anymore, right? We need to get that asset account in our books down to 0. So if it had where is it? Oh, here it is. If it had a $58,000 debit balance in our books, because that's what we originally paid for the asset, we now have to credit it $58,000. So it now has a 0 balance. And our books show we don't have that printing press anymore. Now, accumulated depreciation, we know, is a contra asset account, right? It increases on the credit side because it's the opposite of assets. And so when we want to sell off the printing press, we need to clear out that accumulated depreciation. And so we debit the full amount. We had taken $28,800 of depreciation, right? And so we need to debit that amount to get that account down to 0. We also have to record the cash that we got paid when we sold the asset. That gets debited, right? And then the gain is credited, which makes sense. Because revenue goes up on the credit side, and that increases profits. Stock increases equity, that goes up on the credit side, right? So it makes sense gains would also be on the credit side. And even if you didn't remember that, if you add up the cash plus the accumulated depreciation, that would be more than the credit, right? Because our debits have to equal our credits, that kind of tells you that that $1,800 gain has to go on that side. So that's how we would journalize the sale of the printing press. Questions on that process? How do you think this journal entry would differ if instead of a gain we had a loss? We wouldn't have as much cash, right? Because by definition, if we had a loss, that means we sold it for less than the book value. So we'd have less than $29,200 in cash. Oops, so that would be different. But our accumulated depreciation would be the same. The original cost of the equipment that we're now getting off of our books would be the same. We wouldn't have a gain, but we would have to record a loss. You think that loss would be a debit or a credit?
Debit.
It would be a debit. Gains or credits, losses or debits. And we learned that when we learned deal, right? Dividends, expenses, assets, and losses, right? Yes, they go up on the debit side. All right, what else? In fact, here's a loss. So we see. In this case, they sold it for less than the book value. So they lost $2,100. See that that loss is on the debit side. You add up all the debits, they equal the credit. What if we sold it exactly at book value? Then we don't have a gain and we don't have a loss. But otherwise, the journal entry looks the same. We still have to get rid of our accumulated depreciation. We still have to get the printing press off of our books. And then we still have to account for whatever cash we received. And we are at our summary. Wow. Okay. Good. We're doing really well on time. So long-term tangible assets are used in the course of your operations and will last more than a year, and you don't plan. Well, sometimes you plan to sell it when you're done using it, but it's not like a product where you're planning to sell it, where that's the whole purpose. So we know there are different categories of these long-term assets. Land, building, and machinery, all of those fall under PP&E, right? We have intangibles, copyrights, patents, trademarks, goodwill. All the costs associated with acquiring the assets are added together. That becomes your acquisition cost or your historical cost. Costs incurred to purchase an asset for investment purposes are considered an investment asset. Yeah, we talked a little bit about that, long-term investments, right? If you buy stock, if you buy another company, those are long-term investments. Unless, of course, you're planning to resell them within less than a year. So then you don't treat it like PP&E. You classify it as a long-term investment on your balance sheet. We always record our assets at the original cost, and we don't change that original cost, right? So to keep track of the book value, we need a separate account called accumulated depreciation. So let's see, to calculate the annual depreciation amounts, we take the original cost, subtract the salvage value, and either divide that by the number of useful years or the units of production, the asset, right? Or we could use the double declining method. For intangible assets, we amortize, we just take the cost divided by the useful life. That is our annual amortization expense. I don't think it has depletion on here, but depletion is similar. You take the cost of the asset divided by how many units you expect it to produce, right? Multiply by your actual production, and that gives you your depletion amount per year. You can recalculate your depreciation if something changes, as we went through in that example. And then when you sell an asset, you have to figure out, did you have a gain, a loss, or neither, so that you can record it properly. So there we go. You're now experts on long-term assets. We have only a couple problems to go over. And we have the course project to talk about. So let's talk about the course project first. Keep the recording going here, and then we will get to the problems later. All right, from the course homepage. Oh, I just want to do this. All right, from the course homepage, the course project is listed under the chapter 15 module, but I think the way it's set up, You can't get to future modules until you finish the current module, right? Yeah, okay. So what you could do, I think this will work. Tell me if it doesn't work. But I think you can go just down to this 5th module, course project, and you should be able to go directly to it. Again, if it doesn't work, tell me. And this gives you details on your course project. Now, this project is worth 10 points. So that's a pretty big portion of your course score, right? That's basically, God bless you, that's basically a letter grade, right? Like the difference between an A and a B would be 10 points. And it's not due until week 15. It doesn't show a due date here. Let me switch to student view and I think we'll see the due date. There it is, May 12th. Due May 12th. Okay. So as it says here, you're going to analyze the financial position of a publicly traded corporation. So that means pick a corporation whose stock is traded on a stock exchange. I recommend that it be a company that's based in the United States. If you want to pick a foreign company, you can, but consider that their stock might trade in some other currency. Could be yen or Deutsch, well, no, euros, or who knows, right? So that just might be then harder for you to analyze if you're not used to that currency. So it might just be easier if you pick a US-based company, but that's up to you. But they have to be traded on a publicly traded corporation. So how can you find out if a company is publicly traded? Google it. Okay, you can do that, right? Is such and such a company publicly traded? Yeah, that might get you the answer. In fact, Google will usually, if you just type in the name of the company and then the word stock, that's usually enough. Somebody give me an example of a company. Let's
Apple.
Apple. If we go Apple stock, sometimes without even hitting enter, it'll already give you information. But in this case, it's not. So let's just go ahead and hit enter. And it takes us right to information about Apple stock. So we can see that it is traded. In fact, it's traded on the NASDAQ stock exchange. The symbol for that stock is AAPL. We can see what that stock is trading at and that it's down about 1%. The markets are down today, so it's not too surprising. We can see the historical performance of that stock over the day, but you can go for a much longer period and see how it's done over time. Imagine if you'd bought stock back here, right? Yeah, exactly. Yeah, I don't know if I told you all this. When I was growing up, there was a guy that used to come over and visit my parents. And I later learned, like decades later, I learned that this guy was working at Apple at the time, and that he actually was the one that introduced Steve Jobs to Steve Wozniak. They started Apple, they hired him as one of their employees. He left the company before it got huge. He still works in tech, but he probably thinks to himself, what if I had stayed? Because as an employee in a tech company, you get stock, right? And when that stock does this, then you become ultra wealthy. But anyways, that's beside the point. So that gives us some information, but that's not really the information we need. Oh, this is interesting. You could click right here and see their financials. See what that gives us. That gives us quarterly financials. That's not really what we need either. But that did confirm for us that this is a publicly traded stock. So that's often the easy way to tell. Just do a search for the company stock. I'll show you as an example. The company that always comes to mind that I know is not publicly traded is Koch Industries. It's privately held. So if I were to try to search for their stock, tells me right here, it's not publicly traded. But you notice I don't get that stock information like we just saw for Apple, right? So I would not use that company. Another way you could find out is if you go to the company's own website. If it's publicly traded, it'll have an investor section where they publish their annual reports. And that would all tell you that it's a publicly traded corporation, because a privately held corporation is not going to publish their financials. They're private for a reason. They don't want people to know their business, right? But if you're publicly traded, you have to make that. Your annual report has to be public. Okay, so you're going to pick a publicly traded corporation. And then you are going to research that company. I've given you some websites you can use here. I'm going to go over these websites with you in case you're not familiar with them. But let me give you the big picture first. If you scroll down, you see you're going to submit this assignment as a PowerPoint presentation. And if you don't have PowerPoint, that's okay. There are other ways that you can create a PowerPoint presentation, which I'll talk about. There is a template. So right here where it says, here is a template you can use, don't click on that. Instead, click on the little arrow next to it. Because what that'll do, if you click on the arrow, is it downloads the template. Then you can open the template. If you click on the words there, it opens up in the browser, and but that's not what you want. You want to download it. So you click on the arrow. Okay, so here's the template. Now it's only got 10 slides. You can add slides if you want, but it's not required. You basically just want to follow the instructions here. So on the first slide, you put your name, put the date. If you want to add graphics, that's fine. It's not going to help your score. It's not going to hurt your score. But I know students sometimes like to make it look more interesting. So that's fine. All right, then we get on to the content. So the first slide, it says primary business activities and background. So here you're going to describe what the company does. Pretend that the reader of this presentation has no idea what the company does. Now your writing does not have to be detailed, okay? This is a presentation. It's designed to be projected. So you don't even need sentences. You can give me phrases, bullet points. I don't want to see paragraphs, right? Keep it short and simple. In fact, 8 to 10 bullet points are what are expected. At least 8 bullet points per slide. So again, each bullet point can be pretty brief. It could be, like, let's say, here are some examples. Company's primary business activities. If we were doing Apple, okay. Here we go. Let's say we say product is consumer electronics. Maybe say, cell phones. What else do they sell? Computers, tablets, etc. That's already 1, 2, 3, 4. That's already 5 bullet points, and I only need 8. Okay. Other things you might want to write about: the history of the company. Are they the market leader? Are they a new startup? What's their position in the industry? Who are their competitors? Recent developments? The direction of the company. It's up to you. So just try to give an overview of the company succinctly. If you want to add an extra slide, like I said, you can do that, but it's not required. Okay, then news items. You want to pick at least 2 news articles about the company and summarize those 2 news articles. Now, you'd want to cite and reference your sources here. And 3 sources are required for this assignment. So this will probably take care of 2 of them right here. The Hartnell Library is a great resource because, as you might know, if I were to search for Apple Corporation, is that their name? If I were to search the Hartnell Library, and okay, here's an encyclopedia entry. Let's say I want to use that as one of the sources of my research. Okay, it says it's available online. Let's take a look. Whether I'm quoting or paraphrasing from this source, if I click on this cite button here, see how it has a little quotation mark and it says cite? That gives me a formatted reference. And you can use either APA or MLA. I will accept either. APA is my preference, but MLA is fine. All you have to do is copy that, go to your very last slide, and there's one of your 3 references. Oops, that did not work right. Let's try it again. I don't know why it's pasting up there. Okay, let's try it this way. Okay, it came out a little funky, but okay, there's my reference. Super easy. Now, this encyclopedia entry is written by Henderson in 2021. So back here where I quoted or paraphrased it, let's say I put a quote, you know, Apple is the best company. If that were my quote from that news article, I guess an encyclopedia is not really a news article, but just go with it. What did I say his name was? Henderson, 2021. This is what your in-text citation would look like. All right, you might have done that before for other classes, but this would be the proper way to cite the material that you quoted or paraphrased, and then include your reference. Oh, not there. Here, right? Any questions so far? All right, let's see what else. Again, you'd need at least 2 different news articles and 3 sources. So you could use a source for something else, or like information about the company. Maybe it came from the company's website. That could be your 3rd source. Okay, so then we get into the actual analysis. What you want to do is find 4 years worth of the company's annual financial statements. I'll show you how to do that, but 4 years worth. And what you're going to do, for example, with the income statement, is you'll look at their 4 years of income statements and see how things have changed. Is their revenue going up? Is their revenue going down? Is it staying flat? Look at their costs. Look at their profits. If you want to get into more detail, individual revenue sources and costs, that's fine. But I would say just focus on the big picture, right? Are the company's profits going up, going down? So as it says here, identify any trends that you notice, any concerns, like the company seems to be losing revenue or something like that. Any opportunities you see for the company, okay? So you have to analyze. You have to really think as if you're an investor. Same thing with the cash flow statement. Now, we're not going to get to the cash flow statement until after this is due. But when you look at a cash flow statement, there are basically 3 sections. An operating section, operating cash flows, and that's where the money from selling your product and the cost of selling your product, that's all related to operations. But then there's investing cash flow that has to do with investing, and financing cash flow that has to do with borrowed money or selling stock. So you'll look at those three sections of the statement of cash flow, and again, see how things are changing, right, over that 4-year period. And then go ahead and comment on that. Same thing with balance sheet. You're going to look at how the assets, liabilities, and equity have changed over the 4 years. And same thing with stockholders' equity. So have they increased the amount of stock? Have they decreased the amount of stock? You're also going to include ratios. A lot of these ratios you could probably find. So you'll be, I'll show you where you can find some of the ratios, and they're ratios that describe the company's current position. For this slide, you don't have to worry about previous years. It's only their current, not the current ratio, but only the ratios for right now. Right? Because current ratio is something specific. Here are some examples of the ratios to include: the current ratio, the quick ratio, gross profit margin, price earnings, also known as PE ratio, debt to equity, return on assets, return on equity. All of those, if you cannot find them, it's a pretty simple calculation. So you could calculate on your own. And then what did those ratios tell you about how the company is doing? Then we get to the next slide, your recommendations and justification. Would you recommend investing in this stock? Yes or no? And why or why not? And your 3 or more references. So then when you're done, you go ahead and upload it to Canvas as a PowerPoint file, please. And then I will grade it. Any questions at this point? So I will show you how to, if you don't have PowerPoint, how you could use Google Slides to create this PowerPoint and save it in PowerPoint format. If you have another program, like if you're a Mac user and you use Keynote, that's fine. Make sure you just save it as a PowerPoint file before you submit it. So how many people have used Google Slides? Quite a few. Okay, but it looks like some have not. So Google Slides, slides for women, slides for men. What is that about? Google Slides. I just want Google Slides. Slides.google.doc, I think it is. Oops. Close enough. Okay, so you go to Google Slides. If you are not already logged in, you just have to log in with the Google account. Make your images pop. Sure, why not? Okay. So here I am in Google Slides. It's got this blank presentation, but I don't want that. So what I do is I go to File, Open, Upload, Browse, and then I go to wherever I downloaded that template. Usually downloads. And then what it does is it imports that into Google Slides. So it looks pretty much the same as it looked in PowerPoint. So now I can go ahead and complete my assignment. When I'm done with it, you go to File, Download, Microsoft PowerPoint. So that's how you then save it as a PowerPoint file and then upload it to Canvas. Okay? So you don't have to go buy PowerPoint if you don't already have it. You could just do it this way. Any questions on that? Okay. Let me show you these. Well, I'm going to show you 3 websites. I listed here Wall Street Journal, but I was showing this to a different class and they've changed it. And I couldn't find the information I needed on there. So I would say skip the Wall Street Journal. It's not worth your time. But you might want to use Google Finance and Morningstar. Those are both pretty common websites for researching company information. So let's start with Yahoo Finance. Let's stick with Apple. Again, we already know their ticker symbol was AAPL. So I can just type that in here. And it knows I'm talking about Apple, right? And if I didn't know the ticker symbol, I could type Apple Incorporated, and it's, it still knows what I'm talking about. So let's go ahead and select that. And if we scroll down here, we see, again, we've got information about the company's stock, but that's not really what we want. We've got a menu over here. Let's go to financials. When we go to financials, we've got income statements for the past 3 years. Sometimes it'll give you 4 years. In this case, it only gave us 3 years. So that's not quite enough, right? Because you need to analyze 4. But with some companies, you might get lucky. Now, it also gives us balance sheets and cash flow statements. And notice it says all numbers are in thousands. So like this number here, it looks like it's 383 million, but it's really 383 billion, right? You just have to multiply by 1,000. So that might be one way to find some of the financial statements. You can also, I think under statistics, we'll see some ratios. Yeah, so we've got like the price earnings ratio, price sales, price book. Let's see, is there more? Return on assets, return on equity. These were some of those ratios we needed, right? So that makes it easy if you can find them. Okay, so again, statistics and financials are some of the more helpful pages here. Also news, that's where you can find some news articles. Now, if you find your news articles this way, is that about Apple? Oh, I guess they are about Apple. Okay. This is not going to give you the citation link, unfortunately. You're going to have to figure out how to cite and reference on your own. But it is a way to find some articles. And what you could do, like let's say you really want this article, but you don't want to have to figure out how to cite it. You could just take the name and search for it in the Hartnell library. Maybe it'll come up there, and then you'll have a citation link. So same thing with Morningstar. What's another company? I'm tired of Apple.
NVIDIA.
NVIDIA, okay, NVIDIA, right? NVIDIA, one of the highest revenue producing companies in the world. They make a lot of the AI chips that are getting used right now, from what I understand. So, okay, so we're now Morningstar. Don't pay for anything. If it prompts you, if there's information that you see there that it's wanting you to pay for, you can find the information somewhere for free. But like Yahoo Finance, Morningstar gives us quite a bit of information you can access for free. So again, here's information about the company's stock. If we go to financials, again, we have income statement, balance sheet, cash flow statement. Again, only 3 years, fortunately. Somewhere in here, well, you got news. Somewhere in here, you can find some ratios as well. I'm not going to spend time looking for it. But if you want to save time, let me put it that way, you could go to the company's own website, go to their investor section, find their annual reports, and you're going to have all the data you need. Or you could use Edgar. Edgar is a website provided by the SEC, the Securities and Exchange Commission. And every publicly traded corporation sends their financial statements to the SEC and they get published on EDGAR. I've given you step-by-step instructions on how to use EDGAR, but let me just go ahead and walk you through it. So if we go to EDGAR, it says company and person lookup. Okay, well, you can type in the name of the company, or you could type in their ticker symbol if you know it. Let's just type in NVIDIA. All right, well, it seems pretty clear. This is it, right? NVIDIA Corporation. We see their ticker symbol, their stock symbol. If we click on that, right, it takes us to this page. Now, the SEC is a government agency, right? They don't always make things look pretty. So you have to know what to do. From here, you want to click where it says 10K annual reports and 10Q quarterly reports. We don't want the quarterly reports, but you click here anyways. You could go immediately to their most recent annual report, but what I recommend, come down here to view all 10Ks. 10Ks are the annual reports. Click on that. And now you've got everything that the company has ever submitted to the SEC. Okay? And I would start with their most recent annual report. How many people have ever looked at a company's annual report? Well, yeah, most investors probably don't even do it. They're pretty long. Let's see, let's go to the table of contents here. And looks like this one's at least 84 pages long. But don't worry, most of the information there we don't need. What we're looking for are the financial statements. So here we see financial statements. And click on that. Okay, we might need to scroll down a little bit because it gives us all this information. Okay, and then we see links to some of their financial statements, but I could also just keep scrolling here. We have here consolidated statements of income. That is the company's income statement. And they gave us 3 years. So you can quickly and easily analyze 3 years worth of data right here. For the 4th year, to look at 2021, you could just pull up 2021's annual statement and you know it'll be there. Now, if you scroll past the income statement, we have balance sheets. Then we have shareholders' equity, same as stockholders' equity, and cash flow statements. Okay, so there you go. You can find all the information through EDGAR. Takes a little getting used to, but then it's not so bad. So you're probably getting the feel. There's a lot of research that's going to go into this, right? Not a lot of writing, but you are going to have to spend some time digging through their financial statements, trying to analyze the company, right? Finding these reports, finding those ratios, and then preparing your presentation file. What questions do you have? All right, well, we have plenty of time, right? We've got more than a month, I think I said, right? So as questions come up, let me know. I'll stop this recording here, and what we can do now